A woman drove for a rideshare app for 3 years and made close to $70,000 in her best year. Then tax season hit, and she got a bill from the IRS for almost $11,000 that she had absolutely no way to pay immediately. She hadn't done anything illegal. She hadn't been reckless. Her crisis was an information failure regarding a specific tax rule that only applies to people who don't get a standard W-2. When you work a traditional job, you operate inside an invisible, protective financial infrastructure built entirely by your employer. Look at the boxes on this form. Before your paycheck even hits your bank account, your employer automatically pulls out your state and federal income taxes. Even better, they quietly pay half of your FICA taxes, your Medicare and Social Security contributions, completely on your behalf. You never see that money. The traditional paycheck creates a dangerous illusion of wealth by hiding the true cost of taxes and the automated machinery required to process them. The second you accept a gig, whether that's freelance design, delivery driving, or consulting, that entire automated infrastructure disappears. Every dollar you earn lands in your bank account, completely untouched. The IRS now legally classifies you as both the employee and the employer. Because you don't have an employer covering their half of those FICA taxes, you are now responsible for the full 15.3% self-employment tax. This is the money that funds programs like Medicare and Social Security. Failing to recognize this dual legal role leads gig workers to accidentally spend the government's money. When tax season arrives, they face catastrophic bills they never budgeted for. Knowing how much you owe is only the start. The IRS also changes when a self-employed person must pay it. If you are self-employed and expect to owe a meaningful amount of tax, you are required to make 4 separate estimated tax payments spread across the year. Consider a freelance designer we'll call Surprise Samantha. She treated her incoming client payments exactly like old W-2 paychecks, spending what was there and ignoring the quarterly schedule. She ended up with a massive tax bill in April, plus steep underpayment penalties piled on top. Compare her to Tracked Trevor, a freelance editor making the same income. Trevor built his own infrastructure. He funneled a flat percentage of every payment into a separate tax account, paying the IRS in 4 manageable chunks. 2 workers with the exact same income experienced entirely different financial realities. The only difference was the presence of an automated calendar system. You can actively defend your income by tracking legitimate business deductions. Claiming the IRS standard mileage rate or home office space can strip away a massive portion of your taxable income. Memory-based tracking fails every time. You must capture these deductions using automated mileage tracking apps and by photographing your receipts the moment a purchase happens. If your business grows and your income crosses a high enough threshold, you may need a more advanced structural defense, the S-Corp election. Say your business nets $120,000 in profit. Under an S-Corp, you pay yourself a reasonable salary, like $60,000. That salary portion is subject to the 15.3% payroll tax, but the remaining $60,000 distribution legally escapes that self-employment tax entirely. This structure requires paying for payroll processing and more complex bookkeeping. It becomes mathematically beneficial only past a certain income threshold, so it's a strategy to discuss with a tax professional as you scale. The tax code is a mechanical rulebook. When you engineer your business correctly, you can legally shield thousands of dollars of your own income. The gig vacuum eliminates the corporate HR department, leaving workers entirely responsible for managing their own health and retirement risks. You have to manually source your medical coverage. To soften the blow of those costs, you can often claim a specific tax deduction for self-employed health insurance premiums. For retirement, you must set up specialized accounts like a SEP IRA or a solo 401k. These allow for massive contribution limits that are often significantly higher than a standard IRA. Without a default enrollment plan, you must act as your own proactive HR department to secure your long-term financial future. Tens of millions of Americans are earning a living in the modern gig economy, while dangerously relying on the outdated assumptions of the W-2 system. Success in this economy requires building a manual financial structure. Automate a 30% tax transfer, schedule the 4 quarterlies, track expenses digitally, and evaluate S-Corp status as your income scales. Early system building is the only way to survive. Open a separate tax savings account today and comment your gig type below for tailored optimization advice. Most of us follow financial habits we never actually chose. We use the bank our parents used and handle taxes the way we did at our first summer job. But sticking to these financial defaults is like standing on a moving walkway that's slowly carrying you backward. Choosing a path simply because it's familiar creates a trade-off. You gain the immediate convenience of the status quo, but you risk losing thousands of dollars to invisible institutional structures and IRS penalties. These losses come from two specific landmines. The first is the structural math of for-profit banking, which is legally designed to extract wealth from its customers to satisfy external owners. The second is the transition to the gig economy. If you earn a single dollar outside of a traditional paycheck, treating that income like a W-2 salary triggers a tax system never built for you. This comparison matrix separates the two trajectories. Column A tracks the inherited habits of traditional banking and annual tax filing. Column B follows a strategy of selecting institutions and payment schedules based on their underlying math. Remaining on the default path is a financial decision with a measurable price tag. Because of how these institutions are built, doing nothing ensures a continuous, quiet drain on your total net worth. A traditional bank operates as a for-profit corporation. Its primary legal duty is to produce a return for the people who own its stock. This profit motive dictates the entire customer experience. Every account fee, every loan interest rate, and the low yield on your savings account is calibrated to move revenue upward and out to external shareholders. Credit unions use a cooperative structure, where the customers are the owners. There are no outside shareholders. When the institution generates a surplus, the money loops back down to the members through better rates and lower fees. This reinvestment is why credit unions consistently beat traditional banks on auto and personal loans. Without a profit margin for Wall Street to maintain, they can offer interest rates a full percentage point below the big bank average. This bar chart shows the impact on a $25,000 auto loan over 5 years. At a bank's average rate of 7.5%, you pay $5,000 in total interest. At a credit union's average of 5.5%, that same loan costs $3,600. That is a $1,400 difference for a borrower with the exact same credit score. It's the price of choosing one type of building over the other. These lower rates are a predictable result of the cooperative model. When the structural goal is member benefit rather than shareholder profit, the math works in the borrower's favor by default. The for-profit model also relies on fee revenue. Traditional banks often charge monthly maintenance fees on checking accounts unless you maintain a specific minimum balance. When you add in $3 fees for using an out-of-network ATM, these small charges can grow into an annual cost of several $100s for the average account holder. Because credit unions prioritize members, they typically provide free checking and participate in massive surcharge-free ATM networks that cover most of the country. However, big banks do offer a specific type of utility. For frequent travelers, the sheer volume of physical branches and proprietary ATMs nationwide is a convenience credit unions often can't match. Their massive scale also makes them more competitive for complex needs, like specialized commercial lending or integrated wealth management for high-net-worth individuals. Similarly, online-only banks use their lack of physical branches to keep overhead low. This allows them to offer savings rates that often exceed what even a local credit union can provide. Despite these trade-offs, many people never even look at a credit union because of a decades-old myth. They assume membership is restricted to specific employees, like teachers or federal workers. Most credit unions now use geographic eligibility. If you live or work within certain county or state lines, you are likely already eligible to join. For those that aren't geographic, many allow you to join by making a one-time donation of $5 to $25 to an affiliated nonprofit. Avoiding these institutions because you assume you're excluded is a choice that leads directly to higher fees and interest rates. Our second structural landmine involves how you process income. The moment you move from a W-2 paycheck to 1099 freelance or gig work, your relationship with the IRS changes. The IRS expects tax payments as you earn the money, not just once a year. For most independent workers, this means making 4 estimated tax payments throughout the year. This data visualization compares 2 freelancers with identical incomes. On the left, a worker who paid in 4 equal quarterly installments. On the right, a worker who waited until the April deadline to pay in one lump sum. Even if the worker on the right pays every cent they owe in April, the IRS adds an underpayment penalty. This extra cost is based entirely on the timing of your payments, not the accuracy of your filing. The IRS calculates this penalty silently. You won't receive a warning in June or September. The final number only appears when you file your return. By then, it's too late to fix the schedule. This rule applies to everyone making a meaningful profit outside of a W-2, whether it's a full-time consulting business or a weekend side hustle. Retroactive knowledge won't help you once a penalty is assessed. Protecting your income requires setting up the infrastructure for quarterly payments before the deadlines pass. This scorecard graphic shows how to align your specific income and lifestyle with the right institutional math. There isn't one best bank, only the right setup for your needs. If you are a W-2 employee who travels often, keep a big bank for branch access, but move your long-term savings to an online bank to capture a higher yield. If you are planning to take out a loan for a car or a personal expense, you should verify rates at a local credit union before looking anywhere else. If you have any independent income, you must create a dedicated tax savings account and mark the 4 quarterly IRS deadlines on your calendar today. These strategies work because they acknowledge the reality of how these systems are built. Credit union rates and IRS penalties are simply the logical output of the structural math behind them. Spend 15 minutes today researching your eligibility at a local credit union and scheduling your quarterly tax dates. That small administrative lift can save you thousands over the coming year. Managing your wealth effectively is a matter of design. If you leave your finances on the default path, you are choosing to pay a tax on your own complacency. Samantha spent her 3rd year of gig work landing bigger clients, charging higher rates, and securing a fully booked schedule. From the outside, she was running a highly successful freelance business. The consistent daily momentum gave her the confidence to expand. She upgraded her equipment and invested in marketing, assured that her aggressive business decisions were backed by her rising income. Then April arrived. She sat down to file her returns, and the final number on her screen was so large she physically could not pay it. This diagram breaks down exactly what hit her. As a freelancer, she owed standard federal and state income taxes, plus an additional layer, a full 15.3% self-employment tax. Because she worked for herself, she was responsible for both the employee and employer portions of Medicare and Social Security. She had never separated that tax liability from her regular spending money throughout the year. Treating her gross revenue as spendable cash turned a successful year of hard work into a sudden financial crisis. Because she hadn't paid any taxes throughout the year, the IRS added an underpayment penalty directly on top of her already massive bill. Looking at this 12-month timeline, you can see how the penalty is calculated. The IRS expects taxes to be paid as income is earned. Every time Samantha missed a quarterly estimated payment deadline, she accumulated a penalty based on the amount she was supposed to pay at that checkpoint but didn't. Lacking the cash on hand, she was forced into a multi-month payment plan with the IRS. As she chips away at the balance, interest begins to pile up, extending the life of the debt well past April. The resulting financial stress shook her confidence. She started questioning decisions that had actually been smart business moves, assuming she had done something wrong in her day-to-day work. Earning more money in the gig economy is dangerous unless your financial infrastructure scales alongside your income. Meet Trevor. He works as a freelancer in the exact same field as Samantha. He brings in the same income, sits in the same tax bracket, and is subject to the same self-employment tax rate. Yet his April tax season is completely boring. He sets up no payment plans, accrues 0 interest, and feels 0 stress. This diagram shows the first mechanical difference in his approach: automated routing. The moment a client payment hits Trevor's bank account, a fixed percentage separates instantly and automatically, moving into a dedicated tax account. By locking that money away on day 1, Trevor removes the psychological temptation to spend it. He never perceives his gross revenue as his actual take-home pay. When tax season arrives, the cash is already waiting in an untouched account, neutralizing the shock and panic that usually comes with filing. The second mechanical difference in his system is paying the IRS proactively instead of waiting until April. On this calendar, you can see his tax bucket emptying evenly across the year. By sending the IRS a portion of his saved taxes at 4 specific deadlines, Trevor eliminates the risk of an underpayment penalty. Come April, Trevor simply logs in, confirms his 4 prepayments match his final liability, and settles up the small remaining difference. Trevor's results aren't because he is smarter than Samantha, or because he is inherently more responsible as a person. He simply had access to the right information on day one. He built the required financial plumbing before the money ever started flowing. Operating as an independent contractor offers a structural advantage over a traditional salaried employee. You have access to business deductions. These are operational costs you can subtract from your gross revenue, shrinking the amount of income the IRS is allowed to tax. Look at this blueprint. If you maintain a dedicated space inside your home used exclusively for work, you qualify for the home office deduction. By calculating the percentage of your total square footage that room occupies, you can deduct that same percentage of your housing costs from your total taxable income. Correctly claiming these expenses ensures you only pay taxes on your actual business profit, rather than every dollar your client sent you. For rideshare and delivery workers, the largest missed opportunity is often the standard mileage deduction. The IRS sets a standard per-mile rate. Multiply a daily route by 365 days, and it translates into a deduction worth thousands of dollars. But this requires a consistent daily log. Guess your mileage from memory, and the deduction fails. After surviving her first tax season, Samantha overhauled her business. She implemented automated daily deduction tracking and set up a quarterly payment cycle. Armed with the right financial infrastructure and a dedicated system, her future tax seasons became completely calm, predictable, and remarkably boring. Financial peace in the gig economy is achievable. You just have to stop treating taxes as an annual surprise and start engineering them as a continuous system.